Hi, I'm Drane from Harcourt's Hills Living, and welcome to my April real estate market update. Australian housing values lifted by 1.8% in April, according to CoreLogic's National Home Value Index, with a monthly pace of capital gains easing from a 32-year high in March, 2.8%. Although growth conditions have slowed, housing values are still rising at a rapid pace, up 6.8% over the past 3 months to be 10.2% higher than the COVID low in September last year. Sydney is up 2.4% over the month of April, 8.8% over the last quarter, and 7.5% higher over the past 12 months. The pace of capital gains could slow further over the coming months as housing stock levels rise and affordability constraints dampen housing demand. The slowdown in housing value appreciation is unsurprising given the rapid rate of growth seen over the past 6 months, especially in the context of subdued wages growth. With housing prices rising faster than incomes, it's likely price-sensitive sectors of the market, such as first-home buyers and lower-income households, are finding it harder to save for a deposit and transactional costs. There is already some evidence of fewer first-time buyers in the market, with the Australian Bureau of Statistics reporting a 4% fall in the value of first-home buyer home loans through February, the first drop seen since May of last year. Despite the slowdown, positive housing market conditions remain geographically broad-based, with every capital city and rest of state regions continuing to record a lift in dwelling values over the month. Darwin at 2.7% and Sydney at 2.4% recorded the largest month-on-month rise in dwelling values, while Perth values recorded the lowest rate of growth amongst the capital cities at just 0.8%. The broad trend of houses outperforming the unit sector continued through April as higher density styles of housing experienced less demand amidst elevated supply across some inner city precincts. At the combined capital city house level, values 8.6% have risen at double the pace of unit values of 4.3% over the first 4 months of the year. A preference shift away from higher density housing during a global pandemic is understandable. However, a rise in flexible working arrangements also seems to be supporting greater demand for houses around the outer fringes of capital cities. Relatively weak investor activity, compounded by supply overhang in some high-rise precincts, is also dampening price growth in unit markets. That's according again to CoreLogic. New listings added to the market are now well above average, but strong demand is keeping overall advertised stock levels low. The number of fresh listings added to the housing market has shown a substantial lift relative to the past 2 years. 40,630 new residential property listings were added to the market nationally over the 4 weeks ending April 25, substantially higher relative to the previous 2 years and almost 14% above the 5-year average, according to Mr. Lawless. The rise in new listing numbers signals an improvement in vendor confidence. More homeowners are taking advantage of strong selling conditions while they remain skewed towards vendors rather than buyers. Total advertised stock levels were 25% below the 5-year average in late April. Such low total listing numbers at a time when new listings are above average reflects the strength of buyer demand, fueling the current rapid rate of absorption. Prospective vendors are likely becoming more motivated to test the market thanks to such strong selling conditions, as well as housing prices pushing to new record highs in most areas. The strong selling conditions can be seen in auction clearance rates, which have held in the upper 70% range throughout the whole of April, alongside the fall in median selling times and vendor discount rates, which have reduced to a record low median of just 26 days to sell a home, along with median discounting rate of just 2.7%, also a record low across the combined capitals, that is. Auction clearance rates have cooled a little since Easter, with the combined capital city clearance rate reducing from a recent high of 83% at the end of March to around 77% in late April. Sydney clearance rates edged lower at 80% at the end of the month for the first time since the beginning of February, while Melbourne clearance rates are holding in the lower 70%. That's again according to CoreLogic. After recording a larger decline throughout earlier downturns, the upper quartile of the housing market continues to lead the growth phase. The past 3 months has seen the upper quartile of capital city housing markets record an 8.8% rise in dwelling values compared with the 4.1% lift in values across the lower quartile. This pattern of stronger performance at the more expensive end of the market is evident in Sydney, Melbourne, Brisbane and Adelaide, while the remaining capitals are recording a more even performance across the valuation quartiles. Now a little bit about the rental market. As housing values generally rise at a faster pace than rents, yields have been falling across most regions of Australia. Nationally, the gross rental yield has fallen from 3.72% a year ago to a new record low of 3.5%. The trend towards lower yields is most evident in Sydney, where the gross yield is averaging just 2.69%, down from 2.92% a year ago, and Melbourne, where the gross yields are averaging 2.8%, down from 3.8% a year ago. Such low yields across Australia's largest cities imply an imbalance between housing values and housing rents. Overall, though, conditions remain strong. There are mounting signs the housing market has moved through the peak rate of growth, and we're seeing that. Growth conditions over the past 6 months have been unsustainable and are now succumbing to a gradual slowdown in demand due to worsening affordability constraints, a rise in fresh inventory, high levels of new detached housing supply, and less government stimulus. We are expecting housing values will continue to rise throughout 2021 and into 2022, albeit at a gradually slower pace. Demand should be supported by an expectation that mortgage rates will remain at their record lows for an extended period of time, as well as ongoing high levels of consumer confidence as the economy expands at a faster than average pace. The risk associated with the expiry of mortgage deferrals and less fiscal support have become far less significant. The proportion of home loans that remained on a deferral arrangement at the end of March was just 0.7%, comprising only 0.07% of bank mortgage books. Consequently, we are not expecting any material lift in distressed listings. For borrowers that remain in a distressed situation, the lifting housing values has reduced the risk of selling at a loss. In the most recent Financial Stability Review, the RBA estimates only 1.25% of Australian properties are in a situation where the loan amount exceeds the value of the home, or negative equity. Here at Harcourts Living, we continue to see the market going from strength to strength. However, with expectations of the vendors rising, we are experiencing less occurrences of properties selling for way above the vendor expectations and reserve price. In other words, owners' expectations are more in line with buyer expectations, creating a balance back in the market. Those agencies that specialise in auction and know how to run an auction campaign effectively will continue to achieve great results for their vendors. We have 5 auctions tomorrow, and fingers crossed we'll have all 5 of them sold and we'll have happy vendors. Until next time, I'm Drane, Principal of Harcourts Living, and I'll see you at my May update.